So welcome to the EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. Today, we are continuing with our EIS and VCT Basics series, and we're going to talk about how to pick an EIS fund or a VCT. As a reminder, as well as the audio version, you can see a video version on YouTube, or vice versa if you're watching on YouTube. As we sort of stray into sort of how to pick things, we have to give you a disclaimer that this is not a financial advisor, and anything is taken as guidance. And if you're really interested, you may need to speak to a financial advisor. So I'm delighted today to be joined by Tom Britton, who is the co-founder of SyndicateRoom. Welcome back to podcast, Tom.
Welcome back indeed. It's a pleasure to be here, Brian.
Yeah. So we last had you back on episode 18.
Oh, wow.
Which, yeah. So that makes it about 5 years ago. So in case anyone's forgotten, do you want to tell us a little about SyndicateRoom? Because I think things have changed a little bit too.
Things have evolved a little bit. Episode 18. When we first spoke, we had recently launched our Access EIS fund, which is sort of a data play, a passive play on EIS investing, building large portfolios of 30 plus investments, all of them co-invested with individual angel investors that we've identified to be outperforming of the market. That fund continues to grow steadily, as it's been to. But in addition to that, we've recently launched thematic funds in partnership with different groups. So we have an SEIS fund focused on climate tech that we run with a group called Carbon 13, who are also Cambridge-based. We have the UK's first female founders focused EIS fund, which we run in conjunction with Angel Academy, who are a female founders focused angel network in London. And we'll be launching another fund pretty soon, which maybe I'll be a guest more soon in the future to talk about.
Well, you're always welcome. You know that.
Thank you. I appreciate that.
So today we're focused on how investors should choose the right EIS fund or VCT. So we're kind of assuming that you got to the stage of picking an actual fund. If you're at the stage before that, you may want to listen to episode 122, where we spoke about choosing between EIS and VCTs. We're also probably going to skip over things fairly quick because it's a very involved topic, and more involved than we probably have time to get into the full details of. But we'll maybe start with, what do you think are the right high-level filters? Because a lot of funds out there, how do people get down to a short list of what to look at in any sort of detail?
Yeah, I think there's probably two approaches to it. One, of course, the more traditional, look at the track record of the fund manager and the team within the fund management team as a starting point. Look at what that fund is actually going to invest in. So the theme or strategy of the fund, how diversified the portfolio might be. And of course, if you're using it for tax planning purposes, be sure to pay special attention to the tax year that the fund plans to deploy in, because there are funds that are aiming to get it all done in a single tax year. But if you look at the majority of EIS funds, I believe most of them say 12 to 18 months deployment, which would mean that you're covering more than one tax year, 2 and possibly 3 in some cases. So at a high level, I'd look for those things. If you're less worried about the tax relief, just focus on the theme, what it's going to invest in, and try and find something that resonates with you. I
want to ask a little bit about sort of diversification, because I think, how an investor's existing portfolio or how that relates to the investor's existing portfolio, I think is quite relevant.
So diversification, obviously you've got your broader portfolio diversification, which you've put some research out a few years ago as well on how to include and rebalance a portfolio to include EIS and VCT and SEIS even. But if you're looking at it purely from your ventures allocation and how diverse your portfolio should be from a venture perspective, we've got research that we've shared with you on the power law and the prevalence of the power law in the UK. And in short, what it says is that over time, you should be building to have around 150, so 150 holdings just within your venture portfolio. And that's important because when you look at a typical EIS fund, they're doing, say, 6 to 10 investments, and that gets you a little bit of the way there. And you have to start to build, possibly 2 or 3 funds a year if you can, or if you're going to just do one, you've got to think about it as a much longer deployment. So yeah, diversification is very important.
Yeah, yeah, and I think that's something where you play. So if you're already at that 100 plus 150, then essentially you can pick whatever you want. But you need to plan this probably over a period of years.
Definitely, and what goes into that 150 is also an interesting one, because you have with VC, the data that we have shows that you've got years of good and bad. So you probably shouldn't just try and get to 150 in one go in 1 year and plan it out. But then you also see these cycles. Right now, we're obviously in the AI cycle where there's a lot of attention on AI firms and getting capital. We know that these cycles come and go. Okay, AI is probably going to stick around forever, but as a cycle and where the venture dollars are going, it's up right now. Before AI, you had big data. Before that, you had you had machine learning. You had FMCG for a little bit while, you had cybersecurity for a little while. You have these trends where certain years have different flavors, and sometimes it's more than 1 year. But you need to ensure that you're looking at that as well, so that you don't go heavy on one industry and overweight, and then that cycle disappears and you end up in a downward with your portfolio.
Yeah. So as you say, you're going to find sectors you like, but find more than one, I think, is probably
definitely.
Yeah.
Sector diversification, yes.
Yes. And you also mentioned about past performance. So what sort of aspects of past performance do you think are relevant here?
Well, I think the first one is that past performance is not an indication of future performance. You should always take that with a grain of salt.
I would also add there is academic research that suggests that there may be some persistence of venture capital performance.
I'm happy with you saying that, but on the risk warning side, we have to get that out. So on past performance, I think the big thing is understanding what the fund managers understand, right? And are they investing in things that they understand, and have they invested in things they understood, i.e. talking about sectors, stages of deals and such. What you want to try and see from a fund manager on past performance is consistency. If the fund manager is all over the place and they got it good 1 year, they're less likely to get it good the next year if they're completely changing strategy, sector stage, etc. So I like to see a level of consistency in the funds that I'm reviewing for my own personal investment. I won't name any names, but you have funds who are better off with deep tech. You have funds that understand consumer. And I want to see that if I'm going into a thematic fund, that the fund manager has track record there in that sector and success within that sector.
Yeah. And by success, how relevant do you think exits are?
Yeah, tricky one. Everybody wants to get money back, right? You invest in these things, of course, because you believe in the companies, you get the tax relief, but you want to see returns. Returns, though, are taking a lot longer than they used to take. So if you're trying to base it off of previous return track record, that ball game is shifted. There are very few IPOs right now. There are very few buyouts. What we're seeing are a lot of secondary markets. Effectively, what I'm saying is that the exit time has shifted. And while most EIS funds talk about 7-year cycles, the last 2.5 years, there have been so few exits that you should probably think about it more like a 10+ year cycle. So when I'm looking at it, the track record exits are important, but I also want to see that there's strong growth within the portfolio, and that the follow-on rounds of the portfolio, that you're seeing bigger, more established investors coming into those rounds. So it's not just the same investors propping the company up, that they've been able to attract new money on new valuations and hopefully higher valuations.
Yeah. So those are sort of high-level filters. So if you apply those, you can get your sort of shortlist. So if investors got a shortlist, what factors do you think they should be doing sort of as sort of more detailed diligence, if you like?
Yeah, I mean, obviously being a fund manager, working for a fund management business, I really look into the portfolio that the fund has. I like to know what they've invested in and try and get a sense of why they may have invested in that company. It's not something that I typically ask the fund manager, but it is definitely something that you probably should. Why did you pick this company? How did you know it was going to do well? If you can get detail on the existing portfolio, you'll start to build a pattern yourself of what that fund manager thinks and what they're likely to invest in. I think the other thing that I start to look at is where I think the trends are heading. We use information from Hardin, information from Bowhurst, information from elsewhere to see where the later stage players are starting to look. because you know that they're probably going to do similar acquisitions and investments in the future. So I'm trying to figure out, are there going to be exit opportunities? Again, they'll be longer than they are. But yeah, I'm just trying to figure out, are these companies going to be able to raise at the next round or get acquired at a later stage? And if there's no money for that type of company at the next round, then I probably don't want to go into that fund because they won't see exits from those businesses. Probably not your traditional answer to this, but I do look at it much more as what's in the portfolio and how are they doing.
Yeah. No, I think that's relevant. And speaking about managers, how do you think about manager stability and the sort of staffing at a manager?
Yeah. It's a tough one, right? When the market's moving, you obviously want to see some, call it new blood coming in and bringing something different. In the EIS game, you do see a bit of a merry-go-round. So you see some managers who are here are now over there. That's quite common. But I do like to have a sense of stability with some of the team, particularly the senior managers. And then if some of the analysts are moving firm to firm to get promoted, I think that's all right. Like I said, I'm more concerned with what the portfolio is than the management team. What types of deals have they been able to attract? Do I think they'll be able to continue attracting those types of deals, and using that more as my base than who the managers themselves are?
One thing that we can't get away from in this industry in particular is fees, and I think there's sort of two aspects to the fees. One is they tend to be a bit more complex than for usual mutual fund, and the second is that they tend to be a bit larger. Do you want to maybe talk to those a little bit?
Yeah. So typical VC, you've got kind of a 2 and 20 approach. So you've got a 2% annual management fee and a 20% performance carry. How that works out with EIS, there's always a setup fee, and there's a range from say 1.5 to maybe 3% on the setup fee. The annual management fees typically 2%, but you've got some that are a little bit lower, some that are a little bit higher, and you've got performance.
In my experience, most are lower these days. There has been some a little bit.
Yeah, but then you also have something that you need to pay attention to is third-party fees. So some of the funds use external custodians, or they have fees related to EIS processing or exit processing. I don't want to call them small print fees, but you definitely have to take those into consideration because they will impact your potential returns. You also, then on the performance side, so 20% carry, I would say is fairly standard in VC.
You want to explain what 20% carry is?
Yeah, good point. So carry is the venture capital term for a performance-based fee, and it refers to the amount that the fund manager will take from the exits. Now, when it comes to the carry, there's a few ways that it gets charged. Some fund managers charge it on a company-by-company basis, i.e., we invested X into company one. Company one has returned 200% of what we invested, and therefore we're going to take 20% on the 100% that was above the initial investment.
Yeah.
Some managers do it on a portfolio basis. So you put 20 grand into the fund, and until you return the 20 grand, there's no performance fee, there's no carry, but anything above the 20 grand, they'll take their carry. And the last part around carry is that there are usually, but not always, a hurdle. And the hurdle rate is the amount above the initial investment that has to be returned before the performance kicks in. So on that 20K example, if it's a hurdle of 110, you'd have to receive 22,000 back from the fund before the manager can get it, start the performance fee kicks in. And funds, I don't know if there's a standard anymore. Funds seem to charge different rates, different carries, deal by deal, portfolio based. So really pay attention to that because that'll drastically impact what your returns are.
Yeah. I think the terms do vary, as you say, a fair amount. And they can impact things. I think.
Sorry, there was one more thing. We skipped it. So on the fees, anyone who's listening who's not done an EIS fund before has to understand that the amount of tax relief that you're going to get is not the amount that you put into the fund. It's the amount that is deployed from what you put into the fund. So if a fund manager takes 2% setup fee and 3 years of their annual management fee, which I think is still pretty standard, you're going to lose 3% of the annual management fee and the setup fee from the amount that you can claim relief on. Going to that 20K example, if the setup fee is 2%, if the annual management fee is 2%, you're not going to get £20,000, or you're not going to get your tax relief applied to the £20,000. You're going to get it applied to, I can't even do it in my head, but 18,400. Yeah, thereabouts. Yeah, 92%. Wow. So reduce the amount of income tax relief that you can claim on your investment.
Yeah, and we see some managers who charge fees directly, and we see some who charge them to the companies, sometimes either or, sometimes both. And I think it's fair to say that charging to the company is obviously favorable for tax relief. However, I think we've seen that managers who do charge fees directly to companies often pay a different price, typically a higher price, which compensates for that. So it's not you're getting tax relief, but it's not necessarily a free lunch.
No, it's not. And the other thing you have to keep in mind on that is if you're charging the companies, I think most funds have at least a small fee to the companies, say cover legal costs. But if you're charging the companies a high fee, that company is going to be disincentivized to take money from you. If they're a good company, a strong company, they're probably able to attract capital from other sources where they won't have to pay those fees. So keep in mind that it could create a bias on the company selection because those companies will just go elsewhere.
Yeah. And certainly that's something I've heard. I haven't seen evidence, but it's something that intuitively makes sense. So that kind of covers, so I think if we're speaking about VCTs and EIS jointly, that, all those factors are pretty similar for the two. However, there's a couple of things that I think are very specific to VCTs that are maybe worth mentioning briefly that people need to sort of add into the mix for consideration.
Of course. I think, there are two that come up to mind, and I'm sure you've got one or two more, but the first thing is with EISs, don't expect dividends. You're unlikely to see dividends coming out of an EIS. And of course, if there were, you would have to pay tax on those dividends. Yeah. It's unfortunate. Whereas with the VCTs are almost geared to pay dividends. They keep a certain amount of cash. Oftentimes people will go into a VCT because of the dividends that they're giving. So there's new money coming in from new investors who are subscribing to new shares. There's money held by the VCT. Some of that money, not always, but sometimes it's used to pay out the dividends if there's no performance from the fund. So dividends are a key one. And the other one, of course, is 3 years versus 5 years. So if you go into an EIS and there is an exit after 3 years, you're not paying the capital gains tax. With a VCT, you have to hold on to the shares for 5 years for that income tax to come in. So I said capital gains before, but income tax really for the EIS, you have to hold them a minimum of 3. Yeah. At VCT it's 5.
Yeah. And I think these days that's probably a less material difference in that very few investments are probably going to take less than 5 years.
Yeah, agreed. On the positive, of course, I'm an EIS and SEIS fund manager, but diversification of VCTs out from the start is typically much higher than EIS. So your average VCT portfolio is 30 plus holdings. And with EISs, 6 to 10 is more the norm, with exceptions to the likes of Access Fund and a few others. But yeah, so if you're looking for diversification, VCTs definitely provide that from day one.
Yeah. So I agree with you. If you're starting out, VCTs will give you that initial diversification probably a bit easier. Coming back to your point of dividends, I think being aware of the source of cash on dividends is really important. Yeah. And the other thing I would throw in is venture capital trusts carry cash on the balance sheet in a way EIS funds don't, and that can be a drag on returns. So you may want to sort of check that your preferred VCT is not carrying.
Yeah, if you're paying a VCT, whatever percent it might be, and they're not deploying it, then you're paying a pretty high rate on having cash in an account that could be earning interest elsewhere. So
yeah, well, they are earning interest, but yes, you pay a management fee of 3%. Some of them do reduce for the cash levels, to be fair, so there are some that reduce that. Is there anything else you want to add, Tom?
I think we've covered everything, or most things. Obviously, we could chat longer about EIS specifically, but I think we've given a good enough a broad brush of it. And if anyone wants to get in touch, of course, they can reach out to me or you, and I'm happy to talk about them further.
Yep. And if anyone wants to speak to Tom, we shall post links in the show notes so that you can find him very easily. So thank you very much for coming on today, Tom. Really appreciate coming and giving your insight, because I know, since you moved to third-party fund management, you've got a better insight onto these things than maybe a lot of fund managers.
Definitely. It's been a pleasure, Brian, as always. And I look forward to your next research and maybe being a guest in the not so distant future.
Thank you. So for listeners and viewers, as usual, you can get full show notes and links at harmonandco.com/podcast. You can subscribe to the podcast on all good podcast services and players or through the link in the show notes. If you like what you hear, then please tell a friend or colleague. Give us a review of your favorite podcast app. Click the like button on YouTube now. We can be contacted at inquiries@harmonandco.com. Thanks for listening, and we'll be back next week talking about exits.